India's top two rating agencies, CRISIL and ICRA, have reported their upgrade-downgrade summary for the year that ended last week on Friday. And both point out that the number of upgrades are a bit lower than in the previous year and the number of downgrades are a bit higher. Now, the credit health of corporate India is still better than the last 10-year average, the rating agencies point out, but there is some moderation from the excellent levels that one saw in FY22. Joining me to analyze the FY23 upgrade-downgrade tally are Somashekar Vemuri, Senior Director and Head Ratings Criteria, Regulatory Affairs, Operations, oh God, quite a bit, at CRISIL Ratings, and Jitin Makkar, Head Credit Policy and Senior Vice President at ICRA. Gentlemen, thank you very much indeed for joining me. Mr. Vemuri, if I may start with you. I think it's very clear that FY23 first half, you are comparing first half and second half. First half, you had 5 upgrades to 1 downgrade. It's kind of moderated a bit as you come to second half. Can you just give us the details of the numbers first?
Yeah, thanks, Lata. When we look at the credit ratio, which is nothing but the ratio of upgrades to downgrades, that has moderated to about 2.19 times in the second half compared to a level of 5.52 that we saw in the first half. This was very much in line with our anticipation because when in October we did our previous edition of Ratings Roundup, we had highlighted that we expect this ratio to moderate, given that globally we are seeing higher interest rates and a slowing kind of a demand. So the moderation is very much in line with our anticipation. In fact, export-oriented sectors, have seen a far sharper moderation in both the upgrade rate and then pick up in the downgrade rate, which is there. Overall, when we look at the overall segments, we have seen that upgrade rate has moderated from the high of almost 16% plus in first half last fiscal to about 13.5%. It's still much higher than the 10-year average that we have seen, and the reasons are the steadfast domestic demand which is there, the push from the government, especially on the infra side, as well as the very strong balance sheets for the corporate India. However, on the downside, what we have seen is the downgrade rate has picked up, and at about 6.2%, it stands at, and it's very close to its 10-year average. It's nearing its 10-year average, and the slowing global growth that we have seen, as well as some of the profitable.
Okay. I think we got the gist. Let's get back.
On account of, especially on small is easy.
Yeah, got it. We'll just set that line straight. Mr. Jitin Makkar, your numbers are, you had upgrades of 561 in 22. Now it is dropped to 441. Number of downgrades were 184. They've also come down a bit to 156. But number of upgrades to downgrades were 3:1. Now they are more like 2.8:1. Your thoughts, what did well, what didn't?
I think if we look at the performance, the rating performance in FY23, a few sectors which stood out in terms of high rating activity would be real estate, financials, textiles, and hospitality. Now, the real estate sector, we've seen that there were a large number of upgrades in this sector, continuing with the trend that we've seen in FY22 as well. And we've seen almost 600 million square feet of sales that this FY23 is going to clock. New launches were calibrated by players. Leverage levels had come down. Year-to-date inventory levels are, I think, at a decadal low. So these factors supported the credit profiles of a large number of real estate entities, and that supported the upgrade momentum. Likewise, in the financial sector, we are in a phase where the asset quality of financial sector entities, including banks, has been at its decadal best. Credit growth has returned, and equity mobilization has also been happening. In fact, a large number of upgrades in FY23 were also contributed by fresh equity mobilization by several financial sector entities, particularly the mid-sized NBFCs. So talk about the real estate sector, financial sector. Hospitality sector, again, was a standout sector. Again, from the second half of FY23, we've seen that a large number of upgrades have happened in the hospitality sector, and that's they've shrugged off the deep pain and strife that the sector had been going through in FY21 and the better part of FY22 as well. So these are the sectors where we see a lot of rating activity.
Okay. Yeah, got that. Actually, I want to come back to you on construction and pharma, where in spite of everything going good, those two sectors have not shown that kind of improvement in the upgrade-downgrade ratio. Mr. Vemuri, I wanted to come back to you on the worries you see about the coming year or the year that has just started. Your report points out the fact that inflation persists, even if it is moderated slightly, and that the global headwinds are severe. So do you think corporate balance sheets and hence the the number of downgrades can rise?
So clearly, from our overall outlook perspective, we still anticipate upgrades to outnumber downgrades, going into fiscal 24. Having said that, we believe there may be a little bit of moderation compared to what we have seen last fiscal. Clearly, the domestic demand holding up and the government's continued infra push are positives. And balance sheets also have a reasonable amount of cushion because they are at a decadal low. At a median gearing of about 0.45 times in terms of debt to equity, balance sheets are at their healthiest that we have seen in the last more than 10 years. And hence, even if there is a little bit of pain which is there on the profitability side, there will be cushion to tolerate that. Having said that, typically what we see is, when the monetary authorities take policy actions, the full impact of that is felt with a lag of 3 to 4 quarters. So the rate hikes that we have seen last year by RBI, the effect of that is likely to be fully seen in this fiscal, and hence, you could see some impact on the demand. And on the global side, like you highlighted, clearly there are headwinds which are there, especially from US and the Eurozone. And last but not the least, even from the monetary tightening, tight environment globally, for those corporates where there are upcoming sizable debt maturities of overseas debt, the refinancing risk is also something that we will want to watch.
Okay. Jitin, if you can point out to, your press release also points to similar headwinds, monetary tightening in India, growth question marks abroad. Where will you worry about? Which areas?
Yes, you're right that there are few headwinds that India Inc. is going to be seeing in FY24, but we are not that much worried that it's creating a lot of ruffles in our outlook on the broader economy as such. Even if we see that there is going to be an export slowdown, we're expecting around 6% decline in exports from India, merchandise exports from India in FY24. But if you look at history, in the past, whenever there has been episodes of global economic slowdown, things have bounced up very quickly. Whether you talk about the textile sector or the gems and jewelry sector, FY24, they might see a slowdown, but it might not be to the extent that it becomes unmanageable. And that's why we do not expect downgrades to go too high, too far ahead of themselves in FY24 compared with FY23. Likewise, interest rate risk is certainly a risk. FY24, we'll see the full impact of hiking the interest rates, the MCLR rates, to be transmitted to the P&Ls of the entities in FY24. But there again, the severity is not going to the extent that it becomes unmanageable.
Yeah,
that said,
I get that.
Yes, sport.
Okay. Sorry, I'm hurrying because I'm trying to get maximum from you all in the little time I have. Mr. Vemuri, what would be the specific sectors you will worry about, if at all?
I think, the sectors where debt is very heavy and the interest rates are fairly high, those would be the sectors. Typically, some of the infra sectors would come in that bracket. And the export-oriented ones, clearly, because there is a challenge in terms of the demand globally. So those are the ones where we would typically pay a lot more caution. Also, if you look at MSMEs, even last year itself, we saw that quite a lot of downgrades were coming from the MSME segment. That is also something that we would want to watch out for.
Okay, do you expect MSMEs, the munificence they got, the SOPs they got from COVID or because of COVID will now have run out? So could you see therefore more downgrades, Mr. Memuri, you first, MSMEs, mid-caps?
Yeah, clearly, with the COVID policy kind of relaxations that were there for the MSME sector, now coming to almost an end, and the debt which was there under moratorium, those repayments kind of coming on, their ability to tackle the higher inflationary trends and their ability to kind of pass on higher raw material costs is something which is, which has been tested and likely to continue to get tested. And that is where, there would be a little bit of pressure on the MSME sector.
Okay. I just want a one-word answer from y'all, if y'all can. Mr. Makkar, are you pretty sure that the upgrade-downgrade ratio will worsen a little bit in 24?
Yeah, it should, I think, because downgrades should inch up from here. And a lot of rebound that was due the past 2 years, that would have happened in 2023.
And Mr. Memuri?
I would say moderate from these levels, not worsen.
Not worsen. All right. That's very important, the two words. Thank you very much, Jitin and Mr. Memuri, for giving us a wrap of the year that was and some red flags that we can't have excellent upgrade-downgrade ratios going forward. Upgrades will lessen a bit, downgrades will increase a little. We wrap up on Bazaar. Chartbusters up.